Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at a volatility means opportunity examination again on Mosaic MOS. We're big repeat call buying. We took a look Wednesday at a huge spike in IV based on some unusual option activity, especially on the call side. Seeing big repeat call buying, finally seeing a little bit of a softening of the IV. So taking a look at some trade comparatives that set up ideally to either capture vol or lean bullishly with that big call buying and capture vol as well. So let's jump in and take a look, shall we? First of all, here's the original trade. You can look at the video I published on Wednesday, right, talking about. So here's the scanners, right, identifying big unusual option activity, almost 50,000 options trading versus less than 13,000 normal, right, IV at basically the highest level over the past year. In particular, the June 40 calls saw a big volume of almost 12,000, right, and this identifies unusual option activity that spikes the IV surface. We always like to look at that, right, that moves the IV. You can see here how much IV spiked, right, based on this unusual option activity from Tuesday to Wednesday's close. We're now seeing IV back Wednesday over 50 by a large degree. It had been well under 50 previously, and this is post earnings as well. You can see IV popping here too. Fast forward again, forward to Thursday, we can take a look at the IV, even moving higher, right? So here's Wednesday to Thursday. So even moving up more, we're seeing IV now from the mid 50 level to well over 60. And interesting to note that the call difference between the put difference, right, is now reaching an extreme of almost 6 vol points. So the calls trading at a much higher IV than the puts. Normally you see the puts trading at a slightly higher because stocks tend to go down more quickly than go up. But the fears of the Mideast crisis causing nat gas to go through the roof, which would maybe be a benefit to Mosaic, right, which uses nat gas for fertilizer, spiking IV and huge call buying, people rushing in to use options to lever it out. You can see that IV jumped even more on Thursday, almost 100,000 calls trading, right? IV now at reaching extremes as well. And we can also see what happened on the chart here when we fast forward to Friday, right? We're finally seeing a little bit of softening, right, on the IV. It certainly has come down slightly. We love selling these spikes, right? But always kind of look for the fact that maybe IV is starting to revert here. Here you can see a small move back down. IV coming in just a little bit. Call volume now right around 50,000. Remember, on Thursday it was close to 100,000. We're seeing the long-term chart. You can see IV obviously at the highest level by far over the past 2 years, which certainly favors selling it, but a little bit of a pushback on the IV. Here's a shorter term look, 6 months, right, on a slightly out of the money 60-day 40 delta call. You can see that huge jump in IV because of that big unusual option activity, especially on the call side, and finally giving a little bit of a pullback here. So that sets up ideally for a couple trades. Taking a look at the calls, I did a simple comparative going back to February 12th, right? The stock was at 31.14 at the time. That June 40 call that ended up being the impetus for the trade, basically, was trading at 91 cents, 86 cents to 96 cents, point 91. Days to expiration, 126. IV just under 46 at the time. Plenty of upside on the trade. Fast forward to Friday's close, right? We see the stock closed at 29.31, so $1.83 lower. Yet the June 40 call, right, has closed higher from our benchmark day back on February 12th. The stock at 31.14, the June 40 call closed under a buck at 91 cents with an IV under 46. On Friday, we see the stock much lower, $1.83 lower. The June 40 call actually higher by 12 cents. So a much lower stock price, a more expensive call with 30 days to expiration passing. Normally, time to expiration being less makes the calls and puts worth much less, right? But in this case, because of the huge jump in IV of over 17 vol points because of that UOA, the June 40 calls are actually higher with the stock almost 2 points lower, sets up ideally for a covered call trade for those who like that, right? Buy the stock, sell these out of the money calls, lean bullishly with that call buyer out there, right? And you're able to sell a 22 delta on these calls, right? So you're basically softening up your exposure, the most basic trade everyone's approved for. Another trade we took a look at was a simple call debit spread vertical, right? So again, using the same benchmark date with the stock at 31.14, right? That June 35 call, right? Slightly out of the money, less so than the June 40, trading at $1.94 midpoint. And again, just over a 45 IV. The June 40 calls, we said, trading at 91 cents. The skew in IV, right? The difference between the IV you're buying and the IV you're selling, you're buying a 45.65, selling a 45.84. So basically 19 cents. The out of the money further ones, the June 40 calls, trading at a slightly higher IV than the closer to the money, the 35 calls, which is normal, right? And the spread price at $1.03, right? Paying 194, receiving 91 for selling it. Stock at 31.14. Fast forward to Friday's close, we can see that the June 35 call, right, with the stock now at 29.31, stock has dropped, as we said, $1.87. The June 35 call went down in value, right, by 15 and a half cents. That's what you'd expect. IV did go up, no question, but the call did go down a little bit, 15 cents. But that June 40 call, as we said, rose 12 cents with the stock dropping $1.87. So we're able to buy one option, the June 35 call cheaper, sell the option we're hedging with, the June 40 call more expensive, lean bullishly with that call buying out there, right? And the skew now at over 3 vol points. We're able to buy slightly under a 60, sell slightly over a 60. That skew has steepened dramatically because of that big out of the money call buying, right? Really overpaying dramatically for those June 40 calls. So the spread has dropped, cheapened by 27 and a half cents. So this sets up ideally if you want to follow the flow and capture some vol, reduce the time premium decay as well. You can get in for basically about 75, 76 cents. That's your max risk on the trade. Also note too that the delta on that June 35 call now 34, the delta on the June 40 call 22. Back at our benchmark date, the delta on the June 35 call 38. So that's normal stock drops. You'd expect the delta on the call to get lower, but the delta on the June 40 call actually has gone up 1 vol point. It was at 21 back then, but because of that huge call buying, right, it's now at 22. So you see a difference in that effect too, right? You're able to, in essence, get into a lower delta position for cheaper, right? Buy one of the calls at a lower price, sell the hedge at a higher price. So this makes sense for those who like to have a defined risk trade, but want to follow that big call buying out there, certainly. Another way to capture vol on both sides, right, is to look at the straddles, right? So I went to a different benchmark day, February 7th, right? The stock was at 28.60, right? Took a look at the June 32 and a half straddle. It was priced at 722 back at that time, right? You're looking at an IV right around the 45-ish level, right? Slightly out of the money on the call side, definitely in the money on the put side. So you'd be selling a 62 delta, selling a 37 delta. So you'd be 25 deltas net long. Fast forward to Friday, we see the stock, basically just, hanging in there, right? Going up a little bit, no question, right? But we're seeing that sell straddle exploding higher, right? So even with the stock moving closer to the ideal price, you'd expect the straddle to get cheaper, right? Because we're selling it, it got more expensive. Even with time passing, right? We have much less time to expiration, right? Back then, 131 days. Now we have well under 100 days. So time decay as well. You'd expect the straddle to get cheaper, but because of the huge jump in IV that we'll take a look in a second, that sell straddle now priced at almost 775 before it was under 7.25. So putting the two together, right, we can see that on February 7th with the stock at 28.60, that June 32.5 straddle was priced at 722. The delta, if you would have sold the call, sold the put, right, you're selling an in the money put, a bullish trade, selling an out of the money call, a bearish trade, but much less bearish, right? So net you'd be bullish on the position, 25 deltas, right? IV on the combined trade just over 45. Days to expiration 131. Fast forward to Friday's close. The stock actually went up 71 cents from 28.60 to 29.31. Yet the straddle with the stock moving more towards the ideal strike price of 32.5. Ideally, you want the stock to close near 32.5 or move towards 32.5 to make selling the straddle cheaper, right? But the straddle actually increased by about 50 cents. The delta on that straddle actually got lower, right? Because again, we see that absolute value of those out of the money calls congregate towards a 50, right, with that skew advantage and that huge jump in IV, and that IV jumped over 13 vol points, right, which means that the sell straddle, which should have gotten cheaper from both a stock perspective, right, the stock rallying means selling that straddle at the price above the current price of the stock should have gotten cheaper, right? Time to expiration over 30 days past, you'd expect time decay to kick in, and the call and put both to get cheaper. So you'd expect that sell straddle to get cheaper, but instead, because of that huge jump in IV, right, we saw that straddle get more expensive. So those who want to lean still bullishly, right, with that big unusual option activity out there, but capture vol on both sides, may want to consider that June 32.5 straddle. For those who want to have more of a defined risk trade, consider maybe the June 35.40 call spread, where you're able to buy the June 35 call cheaper, sell the June 40 call more expensive, get into it for about 75 cents. That's your max risk. Or, of course, if you just want to go out, buy the stock, sell that June 40 call for more than it was trading at with the stock $1.83 lower. Lean bullishly, obviously, with that big call buyer out there. Any of those trades certainly make sense. So hopefully identifies how we go about identifying trade opportunities, put a multitude of opportunities out there depending how you want to structure the trade, what you're approved for option-wise, buying stocks, selling a call. Everyone who trades options approved for that. Most people can certainly do a simple call vertical where you buy a call spread, buying the 35 calls, selling the 40 call, right, for 75 cents or so. Define risk all the way. And those who want to take advantage of both sides, right, with that huge jump in IV, who are approved for naked call and put selling the highest option approval level, would certainly want to consider that June 32.5 straddle, that you're still leaning bullishly with that call buying out there, but capturing that huge spike in IV as we talked about, where IV has just exploded higher, right, and finally starting to soften on both sides. So again, how we go about identifying potential trade opportunities here at Tim Bigham's Big Time Options. But as we always say, trading is about probability, not certainty. So make sure that you position size accordingly and have your exit strategy defined before you get into the trade. So until next time, as always, here's a good trading.